welcome to the Stock Out. This is your show at FreightWaves for all things related to the CPG industry. I'm your host, Mike Baudendistel. I'm the head of Intermodal Solutions here. And in addition to Intermodal, also follow the CPG industry. In the show, we set aside about 26 minutes to go through CPG news, usually try to bring on a guest who is knowledgeable in the space. And today we have a guest who's knowledgeable in servicing the space from the 3PL angle. It's going to be Dave Giblin, a VP of Transportation at ODW Logistics. So we're going to be talking to him in a minute. And I'll also go through one news article on the CPG industry. Before I do those things, if anyone has not already signed up for the CPG newsletter that we send out here at FreightWaves, you can do that by going to www.freightwaves.com/the stock out, or just go to freightwaves.com. Up at the top, newsletters. You can sign up for all our newsletters, but stock out's the first one there under supply chain. So you want to do that to try to keep you up to date every week what's happening in the CPG industry. And those companies seem to be performing pretty well based on what's taken place here in earnings season so far. Seems like their elasticity is still relatively muted despite a tremendous amount of inflation the past 3 years, and the margins are up pretty much across the board. So most of the companies were able to beat the analyst expectations last week and raise guidance. So most of those companies appreciate on the news. I'll go through one news story here, and that is another vertical farming company files for bankruptcy protection. This is something that I think is interesting. I've talked quite a bit on this show about vertical farming, try to think about ways that CPG supply chains could change in the future. And there's been some, attempts at this. This is, a graphic from Eden Green Technology. I want to stress that's not one of the companies that's, filing for bankruptcy. The latest company that's filed for bankruptcy is called this App Harvest. It's a high-tech indoor farm company filing Chapter 11 protection. It comes 1 month after Aero Farms filed for Chapter 11 bankruptcy protection, and then in April, Calera filed for bankruptcy protection. There were a couple others as well here in recent months, and would encourage you to go to one article I found that was interesting was in Winsight Grocery Business, which I think does a pretty good job of keeping people up to date on the grocery industry as well as the CPG industry, and also did a show for this show, The Stock Out, where I interviewed executive from Plenty, which is another vertical farming company that is actually in a better financial position. And Walmart's an investor there. They also have a distribution partnership with Albertsons. They're the one that's opening the big vertical farm in Compton, California. So it is an interesting concept. But basically what's happening is that like a lot of high-tech industries right now, the investors have gone from a mindset of growth at all costs to sort of show me where the profitability is, and has been pulling back capital in places where those companies are not yet profitable. So that's certainly impacting the vertical farming industry. There's also a good article that was linked to in that Winsight grocery business article that from Henry Gordon Smith, who is founder of an agriculture consultancy firm, and he said that most vertical farming companies today powered by non-renewable energy sources, and they actually emit significantly more carbon than their field-based counterparts. So for all the desire to reduce supply chains, it's certainly not the consensus that vertical farming reduces carbon emissions, at least not so far. So it's going to be an interesting sector to watch. With that is a little bit of one news story that I think is interesting. I want to bring on today's guest. It's going to be Dave Giblin. He's the Vice President of Transportation at ODW. Dave, thanks for joining me.
Yeah, absolutely, Mike. Appreciate the intro there, and look forward to talking a little bit. A lot going on in our industry right now, so exciting times. And also your vertical farming. We've got a company actually right upstairs in our building here that also does vertical farming, and understand the challenges that those guys are working through. So.
Yeah, it's an interesting thing. I mean, it's one of those things, those topics in the CPG industry. I mean, between that and sort of cell-based meat and sort of maybe plant-based substitution of traditional meat, like at some point there's going to be some, I think, sort of major disruption. But a lot of those sectors have really sort of gone through their challenges, and I think investors are getting more and more concerned with that. So for those who aren't familiar, Dave, why don't you give us a little bit of an overview of ODW Logistics and how you serve the food and beverage industry?
Sure. ODW is a full service supply chain company based in Columbus, Ohio. We do contract logistics, warehouse management, along with transportation management, brokerage. We've been around for a long time, since 1971. Our infancy was with some major food retailers, so we've got a lot of experience in both the grocery and the retail space.
So you're perfect for this show. So what do you think the biggest challenges that they're facing right now are?
Yeah, that's specific to my job. So on the transportation management side, the news with Yellow shutting their doors on Friday and potentially filing bankruptcy today is without doubt the biggest disruptor of the year. We've been doing a little dance over the last several years since COVID. Obviously there was a major capacity crunch through 2021 and 2022. That's all changed a bit in 2023 with the lightness in the freight market, plenty of capacity out there. We were unsure what to expect. Our expectation was that Yellow would likely not make it through the next couple months. Probably happened a couple of weeks faster than we expected. But it was definitely a major disruption that we expect to see across all modes of transportation. But to be honest with you, we were a little bit surprised over the last week to week and a half. It's been a transition, but it appears as though the lightness in the freight market, combined with the additional capacity that existed inside some of your larger carriers, specifically carriers that handle retail, over the past week, we've not seen significant reductions in terms of pickup and delivery performance. So we've, to be honest with you, been a little bit surprised at the readiness within the LTL space in particular, in terms of their ability to kind of quickly take over for the Yellow 30,000 jobs. That's nothing to shake your head at, and there's a lot of trucks, trailers, cross dock facilities out there across the U.S. and for all that, kind of within a couple week period of time to vanish, it's kind of amazing to see.
Yeah, that's exactly kind of what I wanted to ask you, was sort of related to that. And just, Yellow is about 7% of the LTL industry. So you attribute that to just there's excess capacity that is greater than that, and the industry was just able to absorb all that volume without a lot of service disruption?
Yeah, it's hard to weigh. We were preparing for a little bit more of a disruption than we've seen over the last week. It's the last week of the month. I can tell you, in the truckload space today, we're having a lot of challenges getting everything covered. So the capacity, there is a bit of a capacity crunch, but it's the last it's the last day of the month, right? So that we expect those type of things. But more specific to LTL, yeah, we're a little bit surprised. For your CPG customers, I would guess that this is my guess. I would guess that Yellow was probably 20, 30, maybe even a little bit higher than 30% of retail and grocery deliveries were handled by Yellow. There's some other large LTL carriers in the space. Old Dominion is the predominant. Estes, FedEx, TFI to some degree, but to be honest with you, my background in LTL, I've seen the primary focus of Yellow and of Old Dominion to be in the retail segment, and it's really, really the bulk of the other providers had been chasing your more traditional industrial type shipments over the last decade plus. So my expectation was really on the retail and grocery, we would see quite the challenge. And it appears as though Old Dominion has bulked up enough to handle a lot of that. And some of the other guys that I mentioned, the SDs, the FedExes, that they've also got some capacity in place to handle that. One area that I have heard some rumblings is some of your more industrial carriers that are probably carrying some of the potentially government freight and other freight that Yellow had in their network. They've not necessarily seen challenges, but they've bulked up and they're asking some of their white collared office personnel to go out and help on the dock a little bit. So, I think it's a bit of an all hands on deck type of situation here.
That's great insight. Yeah, that's really a lot of great detail. I didn't, appreciate that breakdown with Yellow and Old Dominion. You're doing more on the retail side. That's really interesting. I want to ask you just a little bit about the freight market. I mean, you mentioned that things got a little bit better towards the end of the month. We have a sonar chart that sort of alludes to that a little bit, where we, my colleague Zach Strickland wrote a chart, which writes a chart of the week article every week. But she showed that there it is. You just look at 2023 as that white line. And kind of in contrast to July, typically a weak month after, let's say, maybe a June and a second quarter surge, kind of going the other way this time, up about 7% from month ago levels. Would you interpret that as being any sort of meaningful improvement in the freight market, or do you think that's maybe pulling forward a peak season, or just kind of any thoughts there? I'd be interested to hear your perspective.
No, I've seen the chart. I hadn't focused on it. It is interesting. It follows really a 2020 parallel, and that was a year unlike any other. So hopefully we're seeing a bit of excitement out there in the market. Some have surmised that specifically to the UPS and Yellow strike potentials, that there was some pull forward nature just to get freight out in case there was massive disaster out there. I think it was big news last week that the crisis was averted with UPS. Our projections was that Yellow would be able to be handled by the rest of the industry, but obviously UPS, there was no chance it wouldn't have happened. There was just way too much freight moving through that network. So it's a good question. I hope that we're seeing some brightness out there. Across our customer base, we are seeing the same sort of lift over the last couple of weeks here and into the last week of the month. So hopefully that trend continues. I think it's a nice chart that you showed there, because clearly in the other 3 years in that 5-year view, it was very flat in July, and that's normally what we see. Is you don't really start to see that pickup until August, going into September, and then your fourth quarter push. So to be determined.
Yeah, I mean, I think it was interesting sort of perspective that is maybe risk mitigation, shipping for sort of risk mitigation purposes, and maybe just want to ask you about a different method of risk mitigation. Is we're in this loose freight market now, not going to last forever. At some point, there's a shakeout of capacity and or just freight volumes improve. We don't know when that's going to be. Your shippers, how would you advise them to, sort of, protect themselves against the eventual capacity crunch?
Well, you always want to be balanced in all things. So, right now, to take too much advantage of the spot market in truckload or even across the LTL network, it's clear for those shippers that were Yellow heavy, they're probably having a lot tougher week this week and last than those that had kind of spread their eggs out, a little bit more balanced situation. So I think it's important that you stay abreast of the market, see what's going on. Certainly from a dedicated carrier perspective, we've looked over the last year here to try to invest even further there to give freight to carriers that need it out there, that can be future partners. Even if you're paying over market, there's still obviously probably at least a 50% delta between the contract and the spot market, and to strategically overpay for good relationships and good ongoing opportunities, I think is the smart thing to do in the truckload space. And in addition to LTL, I think you really got to do the same thing. It's not all about choosing the low cost provider. And frankly, it's not always all about choosing the optimal carrier between low cost and service. Sometimes you have to think about future and contingencies and having backup plans. I think, it's no time is better to understand that than understand, looking at Yellow, and certainly there were many contingencies being made with UPS as well. So I think those are good things to be thinking about right now as we reflect on the last month here.
Yeah, it does seem like the shippers are doing more as far as managing those contingencies because they've gone through just so many supply chain disruptions. A lot of these CPG companies have said, "Well, I've never seen a situation like we've had the last, let's say, couple of years where they didn't have the ingredients, didn't have the right packaging materials, all of those things." You do a lot with strategy. How do you balance the desire to have more resiliency in the supply chain and sort of managing those exceptions versus just having a network that's more streamlined and maybe lower cost overall?
Yeah, it's a great question. And I would say it starts in the boardroom. It starts in the executive room. There's got to be, and there has, I'd say over the last, certainly since COVID, and I think the trend had really started before that, is that supply chain is a major impact on a business, right? If you're shipping goods and your supply chain is constrained in any fashion, that can have downstream impacts of disappointing customers, and that's never a good thing. So, I think that the more that the executive and boardroom sees that, if you've got visibility to your supply chain, you can run scenarios to determine, what is the cost impact of having redundancies, having contingencies in place. And a lot of times, if you're looking at a P&L statement for August, right, next month, versus what's it look like over the next 5 years, I think you want to be making decisions based on both of those, because just if it looks good for your August numbers and it meets your service expectations, that doesn't necessarily mean that it's going to position you most effectively for 3 to 5 years down the line. So whether it's building out your technology stack or determining the right 3PLs or carriers to work with, I think those are decisions that really should be had on a weekly, if not monthly basis, within your operators, and then to wrap that back to the executive and boardroom. I think those are things that, from a financial perspective, they need to be looking at those as long-term investments in potentially shorting the P&L for next month, but at the end of the day, you're a lot safer and better off with these kind of more sustainable type of scalable solutions.
Yeah, always sort of have to balance the near-term results with the longer-term results. Particularly hard for the publicly traded companies to do that. What size companies do you typically work with on the shipper side? Are they the big, ones that are publicly traded, or are they sort of smaller ones that are scaling up, or who's the one who gets the most value from ODW?
Yeah, perfect question. So we do work with some publicly traded companies. Those are some of our better customers. But honestly, I think where we create the most value is the mid-sized shipper. We kind of look at our customers as they don't have the scale to compete in the CPG space, for example, with a Unilever or a P&G. And our effort is to give them an all-in-one solution between warehouse and transportation, that we give them a platform and other shippers to consolidate and combine forces with, to give them a competitive edge that gets them close to the same scale and cost basis that you'll see with the Unilevers and the P&Gs out there.
Yeah, really sounds like that adds a lot of value, particularly for those shippers. And how does a company like yours help those sort of mid-sized shippers prevent the on-time and full fees?
Yeah, so that's going to be of particular interest over the next couple of weeks here as we see what happens with with Yellow. I know there's a lot. Really, the majority of our shippers ship LTL freight through their network, and our program basically takes LTL freights and turns it into truckloads. So LTL freight, most shippers struggle, say, to deliver in the 80s to low 90s would be a pretty good LTL score going into most retail facilities. If you can transition that to truckload, you've got an immense amount of additional control in terms of scheduling delivery appointments, tracking the truck, less moving parts. So we try to do as much consolidation at the front end. And the result of that is certainly a cost benefit, but oftentimes more importantly is the consistency of the freight and driving into the high 90s in terms of on-time percentage. So that's something that we've had in the works for a long time, kind of building out this consolidation program, and we've seen the ability to give control and flexibility back to the shippers to be huge.
Mm-hmm. Yeah, and you mentioned there that you help shippers out with the warehousing. What are you seeing in the warehousing market? I know it was really tight for some time, and there was a lot of building. Where does it stand now?
Yeah, it seems like it's probably 6 to 9 months behind the trucking market. It was very tight, very challenging to find available space out there. I do think we've seen a massive impact in the warehousing space from Amazon, somewhat de-emphasizing some of their growth plans in terms of warehousing and distribution. There seemed to be some deals that they were walking away from. And with their size, I think they were not alone in terms of some of the large companies out there that with rising interest rates are starting to get a bit fearful in terms of what the future holds. So we have seen space become more readily available over the last couple of months. That has not necessarily transitioned into rate reductions at this point, but the availability of space as that continues, I think we'll continue to see some opportunities at cost reductions out there as well.
Mm-hmm. Yeah, that's good. That makes a lot of sense. It's sort of interesting that it's behind the truckload market, but I guess that makes sense. It takes some time for the goods to move through the warehouses. I just wanted to ask you again. I mean, you mentioned the food and beverage as one of your areas of expertise. Are there any sort of specific logistical challenges other than what we've already discussed that are really specific to that type of shipper?
Well, food and beverage, you've got some perishable items, at risk there certainly, but it really comes back to that. Walmart calls it the MABD, other calls it RDD. These guys, their goal in life, the retailer, is to have the product on the shelves and be able to sell it so that their sales increase. And down upstream from that, you've got your vendor community that is looking to make sure that their product is on those shelves that they've been given access to. So I think an immense amount of work has been put into the supply chain over the last decade in terms of the technology, the teams, the analytics that go into predicting what the consumer is going to buy, and then kind of backfilling it from there to make sure that you've got very efficient supply chains to support that. So, at the end of the day, I think it is much trickier for a supply chain, or I should say for a retail shipper to ebb and flow with the expectations of their customer in terms of that end delivery. And I think you need great partners that you can count on to help do that. And frankly, I know Yellow's been down talked over the last 10, 15 years, but they did provide a good service into the retail space. I think that is going to be a major impact, whether it's today or if the market really continues to peak up. I think you're gonna see that hurt over time, right? You may have the 10, 15% capacity that's available today, but if we're going to look to get back to a growing economy and back to 21, 22 type of volumes, I think you're going to have a lot of work needed in terms of building up capacity in the trucking community to get back to that type of volume.
Mm-hmm. Yeah, it's great to hear that perspective. I really appreciate the perspective you can bring on yellow, on what might happen there, on what needs to happen now going forward. For folks who want to reach out to you or ODW and learn more, how can they do that?
Yeah, just go to odwlogistics.com. I'm on the contact page for the website, and look forward to hearing from everybody. It really is. It is the right time if you haven't got contingencies in place to find some for as this market ramps up. So look forward to hearing from everybody.
Okay, sounds great. Thanks so much for joining me on the Stock Out.
Good deal, Mike. Thank you.